What's going on with BlackBerry, and why is it that traders are keying so much on everything that this company says?
Well, there's been a big decline. It's off 20%. If you look at the stock, it's dropped from 18. I'm looking for some key support at the $8 level. That was the November breakout, so I want to lean on that level. I want to be a buyer near $8 in BlackBerry. The reward is greater than the risk at these levels, I think.
Now, Alan, that's one side of things, but Andrew, you're not maybe quite as optimistic on some of these parts of BlackBerry, right?
No, actually, I think that it does go higher between now and the end of the year. Like he said, it went from $18 to about $9. I think the floor is a little bit lower than here. I think the floor is around $6. They have about $5.70 a share of cash. We've seen this before in HPQ, in Best Buy. I thought both those companies are going out of business. So I think there's upside potential for BlackBerry, but I want to always define my risk versus reward. My trade is very simple. It's a bull call spread in January. I get 2 earnings catalysts in there. I can buy the January 10-15 bull call spread. I can do this for about $1. On this trade, I'm risking $100 per one lot. I can make $400. It gives me a 4-to-1 reward to risk setup. I don't want to be selling puts in this name because it has been bruised so badly.
Gotcha. So he doesn't want to sell puts, but Alan Knuckman, you think that there's a level you would be comfortable owning this stock at, right?
I do. I like $8. I could put in a price order to buy at $8, or I could sell the 9 put. I sell the 9 put for August here. It's got 39 days left till expiration. I sell the 9 put taking 40 or 50 cents. My basis is $8.50. If I get it put to me, that's 11% lower than we are here. And then in the future, I could sell covered calls against it if I so choose. So I'm using the put selling strategy as a way to get in at a level that I'm comfortable with, because this is a stock I want to own for the long term. And if you think about it, my basis at $8.50, that's $850 my maximum risk per option sold.
Me and Alan talk about this all the time. I look at my risk versus reward setup. I'm looking at a 4-to-1 reward to risk setup. Alan's trying to make 40 cents. If for some reason ICON comes in here, the stock goes to 15, you just made 40 cents.
I'm getting a 5% return on my risk in 39 days.
And I can get 400%.
You can, but you need a big move.
Yes, I agree with that.
All right, so here, there's the 2 takes. Let's bring in another voice to this, because Michael Purvis, you've been here with us for the entire hour. On BlackBerry, this is an interesting stock to look at, not just because of the drama that's playing out, but also because of the price dynamic. How would you be playing this particular name, given the options trade right now?
This stock is an option itself, and it's actually.
What do you mean? I mean, what?
Well, I mean, I think it has a fair amount of binary outcome over the broader term here. This is not something I think you could just put in your PA and forget about it for 10 years, the way you might with ExxonMobil, for example.
So how exactly would you play it then, Michael?
Well, actually, I'm partial to the bull call spread, to be honest with you. When I was looking at it this morning, the implied vols were not terribly expensive. They're relative to how they've been trading, relative to realized, and selling puts here on this kind of stock makes me nervous.
So Alan, Andrew, let's talk about this. Andrew, you first. He likes the call spread. He likes the bull call spread here. I mean, again, with your 2 views, why is it that the bull call spread does work or maybe doesn't work here, guys?
I talk about this a lot. I don't like to be selling puts in names that are so battered down, especially cash-secured puts. Like I said, you can only make 40 cents on a trade. You're risking $860 to only make $40. I don't want to own this stock. It can go lower. It can go down to that $6 level. Then those puts would be worth $3.
I can buy the stock 11% lower, or I get paid not to. Then I can write another option for the next month and write another option for the next month. Until I get it put to me, I continue to use this strategy as a way to get into a stock I want to own at a lower price. And again, you mentioned it's an option. You know, it's priced like an option because it's $9 right now. What's the downside from $9? It's not going to 0 most likely. You know, it has intangible value. It's a brand. There's something that can be done with it. It's not going to 0 in my estimation.